I'm here to give you the full recap and deep analysis of ICSC Florida, which is the largest commercial real estate conference in the state of Florida and actually also the largest in the Southeast United States. I'm going to give it to you from the perspective of an owner-operator that has been in commercial real estate for over 25 years. So let's get started. For the first maybe 15 minutes of the video, I'm going to give you kind of the high level sentiment and some of the key takeaways from the halls, walking the halls and meeting the people over at ICSC. Then after that, I'm going to go into kind of the analysis of the event itself, maybe some tips for next year, some things that maybe are a little bit more geared for the industry people rather than just more broad. So that's kind of the structure that I'm going to go with. 2025 is turning out to be better than 2024 in terms of sales, investment sales, in terms of leasing, in terms of capital raise, and just in general, the velocity of deals. And retailers are still hungry for new locations. In fact, the string of bankruptcies that you've seen the last 6 to 9 months have opened up a lot of options for them. So they're very happy about that. And the deals that they're doing are making the leasing associates happy too, because now their transaction volume's up maybe from last year. The issue with last year, 2024, was that from a leasing standpoint, the occupancy levels were so high, meaning that the vacancies are so low that there wasn't a lot of opportunities to lease. So that's I've heard a lot from leasing associates that said, hey, I'm leasing myself out of a job. I'm just completely leased up. I don't have the opportunity to do the deals. And with the bankruptcies, it actually opened up a lot of options. And luckily, there's hundreds of retailers still looking to expand, or thousands of retailers, and they quickly backfilled many of those options, and a lot of deals were getting done. Also, from an investment sales perspective, last year, 2024, a lot of stuff was selling at negative leverage because the cap rates were still relatively low and the interest rates were higher than they are today. Fast forward to 2025, the transaction volume from the investment sales guys are up. They're happy about that because cap rates have kind of moved up a little bit while interest rates have moved down. So, but they're pleased about that. And then there's been a lot of equity being raised by various groups. I'm talking about hundreds of millions of dollars, if not billions of dollars, but hundreds of millions from individual groups to go pursue the acquisition of grocery anchored shopping centers and strip centers. So that is a strong conviction on that asset type of the strip center, which is where we are. Saglo owns shopping centers across Florida, Georgia, and now Maryland. And I would say that while the vacancy levels last year were probably for sure they were the lowest in decades. It was close to 3%, and it might be lowest ever. Today, they're up a little bit from last year. I think it's maybe 3.5%, but still very low when you look at it across history. Pre-pandemic, you're talking about vacancy levels of 4.5%. That's kind of normal. So 3.5, while higher than last year, is still very low. And also, there's still not a whole lot of ground up construction going on, bringing new supply to the market. So that supply side of the equation is still a little constrained, and that helps to keep the rents high and then also the vacancies low. There is very little talk about, let's say, tariffs or any kind of real headwinds, even from the retailers. And so it kind of feels like it's full steam ahead. Again, that's just the sentiment. I'm not measuring this, as far as the actual effects of the tariffs now that they're in place, and it's kind of a moving target. But the sentiment was that there was not a lot of discouragement because of those tariffs. So the headline news in the media, the mainstream media, would have you believe that that there's the bankruptcies across the retailer space are a real issue, and I think there's like Big Lots, Joann Fabric, I think Hooters might have filed, Cons and Badcock, and I can't, Party City, and there's a few others. But I would say that that headline scare, I guess, inside of the industry when you're walking ICSC, that really wasn't talked about either. Mainly because a lot of those spaces, as I mentioned before, that the minute that Joanne Fabric filed bankruptcy, and you knew that all those spaces were going to open up, I mean, other retailers were just jumping on it. And from the inside, it's just well known that a lot of these retailers didn't keep up with either one of two things. Kind of just took on too much debt, or and couldn't service the debt, or didn't keep up with the times as far as the customer experience inside of the store or the merchandise that they filled the shelves up with. And you got to just make sure that you're keeping up with what the consumer wants, which is a great shopping experience, and great merchandise. I mean, the fact of the matter is, a lot of the direct to consumer DTC type of businesses like Casper and Warby Parker, there's a few others. They all Allbirds, they Away Luggage, they all realized that they needed to open up bricks and mortar stores, because the customer acquisition cost, if you're only online, is so large, and to keep your branding in front of people, just the cost to do that is so large that it starts to make it unprofitable, and you have to have some sort of physical presence. I mean, even Amazon's opened up like their bookstores, their 4-star, various concepts, and they bought Whole Foods. So certainly that's what we're hearing as in terms of the bankruptcies and the sentiment on retail. And look, at the end of the day, with the bankruptcies, even Jeff Bezos had said at one point, every business goes out of business at some point, and even Amazon will go out of business at some point, which is what he stated, and that's true. I mean, the Sears Roebuck was the Amazon when during its heyday in the 1960s or 50s, where everyone had a Sears card, and everyone was buying through mail order. They're selling houses through mail order, which is kind of crazy. And they filed bankruptcy, and so, and Walgreens now, which was great credit 10 years ago or 15 years ago, uh, it was Walgreens was cited in Jim Collins's book From Good to Great, and they're going through their own economic issues right now. So every single business, every single company will eventually go out of business. We just have to acknowledge that, and it's just a cycle of the business cycle. No companies last forever. There were over 200 different retailer concepts that were present at the conference. So that's over 200 different companies that are retailers, either medical service, restaurant, retailer, tenants of shopping center space at the conference. And so that just shows you how much demand that there still is. In fact, 7 Brews Coffee, which has been in the news quite a bit because Blackstone has a significant investment in the company, just 2.5, 3 years ago, they had 15 locations. 15, 1-5. And today, they actually have 500 locations. So in the course of about almost 3 years, they went from 15 to 500 stores, which just shows you, again, how much scalability and demand there is for that physical retail. All right, we're here with 7 Brews Coffee.
How are you?
We got Shay, an amazing growth story. Shay, tell us the story.
Yeah.
When you started 2.5 years ago, how many locations were there and how many are there today?
Yeah, so there were 17 locations just a couple of years ago. Today we're at 460 stores, and by the end of the year, we're going to be excited to announce over 500 stores.
That is crazy.
Yeah,
wow.
Yeah. A lot of coffee.
That's right. Good luck.
Thank you.
And I spoke with Shay Anderson, who is their real estate manager, about the growth, and she's been with them for about 2.5 years, and it's just extraordinary. So that that bricks and mortar continues to thrive, and our vacancy levels are still at historic lows, although not the lowest of the lows. That was last year, still very low, and the rents continue to hold its ground, especially in the growth states. So where we're at, so Florida, the Southeast basically, and Texas, but there could be states maybe in California or in Oregon or Washington State or maybe even Las Vegas. I don't know where the rents have gone down, but if you look at it across all of the states on average, in general, it's doing very well. And that's part of the reason why so much capital is moving into that retail asset type of commercial real estate. Um, the local experience for each of these stores are super important and probably don't get enough attention. You can have a great concept, you can have great merchandising, and you can have a lot of money backing it, but you have to execute at the local store level, meaning that that local store manager that affects the total experience and makes sure that the merchandise is properly displayed and properly inventoried is so important. And part of public supermarket success is that it is one of the largest, if not the largest, employee owned retail company in the United States. And each of their employees are also shareholders of the company. And so that ownership mentality is a secret to success. And I've gone to many concepts that were great concepts on paper, or maybe they're great concepts at other places. But when I went there personally and shopped there, or spent money there, I thought, this experience that didn't really live up to the hype. So that local store experience is so important. Liquidity in the capital markets remain very strong from both the debt and the equity side of the spectrum. I speak with a lot of lenders. They are excited to put term sheets for financing shopping centers for retail. A lot of them are underweight on retail actually right now, and that also goes for credit unions, that goes for life companies that provide debt, that goes for the CMBS market, and also a growing part of the debt options is the private debt. So that, and I'm not talking about bridge debt, but I'm talking about private long-term financing. That is also very active in our space right now. And on the equity side, as I mentioned before, I know there's companies like the ones. So I'm careful what I'm mentioning because I'm not sure what's been shared only to me and what's been shared also to the news. But I know that Ram Real Estate was in the news recently, and they've raised. I think they're raising hundreds of millions, or have raised hundreds of millions to buy property. And there's several other groups that I had spoken with that are raising nine-figure numbers to go acquire more shopping centers and more retail, which is really interesting. And strip centers, they've been a favored asset class for all the reasons I stated. Your rents remain high, your vacancies remain very low, but also the lease structure is a triple net lease, which gives you a little bit more insulation to inflation, because if your expenses do go up and they fluctuate, your insurance might go up or down. Our insurance went down last year. Thank you, Jamie, with IOA, very good insurance broker.
Throw a party, have good wine, good people, the deals will come. So, cheers, everyone. Cheers. And with that said, please look at your menu because they are.
Real estate taxes go up usually, and we contest it every year and try to make sure that we're being assessed fairly. And then your recurring maintenance services also, go up or down. Your landscaper, your cleaning company, the asphalt person, roof repairs, all of those things. So those costs in a retail setting are passed through to the tenants because the lease structure for retail is a triple net lease structure, which means that expenses are passed through. In addition to that, very little inventory has been constructed. Prior to the great financial crisis, the total square footage of retail was growing at a pace of about 2.5 to 3% per year in new construction, meaning that 2.5 to 3% of the gross leasable area was being built every year in terms of new construction. Since the great financial crisis, that amount, I think, went down to about 1/2 of 1%. And then since COVID, it's been under 1/4 of 1%, so barely any growth. And that static inventory where the lack of growth, meaning that the supply is constrained, is another reason why the retail asset class has been favored. Where industrial real estate taxes real, they've been building like so much industrial that they might have overbuilt a little bit. There's a fear of overbuilding that, and same thing with apartments. They're not sure if maybe they overbuilt in some cases, and then when you do that, your vacancy goes up. Once your vacancy goes up, your NOI goes down, and you're already so tight in those asset classes because the cap rates are so low that can really put you in danger of maybe failing a debt covenant or something like that. I would say that the retail does have a little bit higher cap rates than industrial and multifamily. And also, I've heard from a few of the lenders that there's just a great positive track record for retail over the last 5 to 7 years, even through COVID. I mean, there's very little retail properties that have gone back to the lender, like almost none. I talked to all the banks and all the lenders, and I asked them, hey, do you have any REO assets that are real estate owned assets that are shopping centers? And no, they have absolutely no problems with retail shopping centers. They're only having maybe some problems with office buildings in some cases, maybe apartment buildings where they paid a little too much and then expenses are too high, and they're not able to pay down the loan. And so here or there, but retail is a very strong asset class, and that just shows the track record has been good. And even, like I said, even with COVID, you had these shutdowns, and for the strip center space, people quickly realized, hey, this tenant mix is largely essential use, is largely necessity and daily needs, at least the stuff that we have. Your pharmacies, your restaurants, your insurance companies, your medical offices, and coin laundries, things like that. There was a lot of necessity there. And so that really weathered the storm, and especially in the states that opened up a little quicker. So there could be states such as New York, Illinois, and certainly like San Francisco and Santa Monica, where you see on YouTube or something like that the retail there is really suffering. Those are just the micro examples. That's not the overall. That's just in the exceptions to the rule, if you will. So just be mindful of that. The municipalities are still very slow at permitting and approvals and the inspection process. And so what that's doing is that's causing tremendous amount of delays in stores getting open. So before and it's kind of strange because you think that over time things get more efficient, especially with new technology. The technology from 2018 till today is completely different, right? So with new tech, you're getting so much more done. You're looking at ChatGPT, you're looking at all these automations and things like that. But before COVID, you're able to get a tenant open on average, 4 to 6 months for your typical retail tenant. And now you're looking at maybe 9 to 12 months in some cases. And so that's a huge amount of months of delay, and you multiply that over tens of thousands of locations across the country. I mean, thousands of locations just in the state of Florida over the course of a year, and each of those locations is a business, and each of those businesses have dozens of employees. So you're talking about millions of employees getting delayed in starting their job because of these delays in the municipalities with permitting, with approvals, and the inspection process. I think that a real boost to the local economy and therefore the national economy could be just figuring out a way to really speed up that process, make it so much more efficient, and just get it down. Like if we can get tenants open in 2 to 3 months as opposed to 9 to 12 months, think of how much more um, taxable income is generated from the businesses themselves. And then the taxable income for the property and the property owners, with the rent, that's income for property owners and we pay taxes. And then the employees earn income because they're getting paid a salary and they pay taxes. And just think of how much more good that can do to quicken the pace of opening from 9 to 12 months to 2 to 3 months. And it can get there. It can 100% get there. Plan review with today's technology could probably get done in minutes. And inspections as well could probably get done in a fraction of the time that it's currently happening. So just some investment in that improved process and technology can yield 100-fold when you look at the domino effect of retailers, of the employees, of the community that they serve, and also the investors of the property. So I mean that's a big thing. The final attendee count for ICSC Florida was 4,139 people. That's according to their website that I looked up this morning. And this morning is Labor Day weekend 2025. What I found was using ChatGPT, I uploaded the PDF of all the attendees. There were over 200 separate retailer companies that were represented, more people that work for retailers, but just the companies were over 200. There were over 290 landlord companies that were there. There were 51 investment sales companies that were attending, 28 technology companies that were attending, 230 vendor and service companies that were attending. And what I call that means like GCs, architects, engineers, landscaping, facilities management, things like that. And then there were 21 banks or other, specifically banks. That's what I look for. 21 banks were present, and which was interesting because so that's I think a total of almost 800 types of companies themselves. I mean, again, there's over 4,000 attendees, but 800 companies. That a company like Saglo, we own and operate shopping centers across Florida, Georgia, and the not Carolinas, soon to be the Carolinas. We are looking to go to the Carolinas. So if you are selling a shopping center in the Carolinas, call us. We would potentially want to buy it because we are looking to expand our footprint. But 800 different companies for an owner investor like us that we'd want to meet. And there's just not enough time to meet everybody, right? At any given day, or over the course of, so the event really starts Sunday afternoon, and it goes, and it's all day Monday, and then Tuesday it ends at 2 p.m. from 9 a.m. to 2 p.m. So really you have maybe 24 hours if you're like really hustling hard across those 3 days. And maybe you might you can have 50 conversations that are good conversations, like meaningful, significant conversations that you're taking notes about it, and there's a call to action at the end of it and things like that. Maybe you're spending 20 minutes with them, talking to them, or maybe half an hour, 50 of those, right? If you're superhuman, maybe that gets up to 100. I mean, 100 20 to 30 minute conversations would be a lot. You'd have to line it up and just know a lot of people. You could do that. But there's 800 companies there, so you're only at any point you're only touching 6% to 12% of the companies that are there as an individual person. So the point being is that I did hear some, you might hear like, hey, it looks like it's less attended this year, or there's less people. Just don't focus on that. Just focus on trying to your bandwidth. Your limiting factor isn't whether there's 800 companies or 2,000 companies. It doesn't really matter. Your limiting factor is your time, and you're only going to be able to get to 50 to 100. So just pick the best 50 to 100. Doesn't matter if there's 800, 2,000, 10,000 people. Doesn't matter. Just get the most out of it yourself, and there's plenty there to choose from. So a little bit of breakdown. Out of the 200 retailer companies that were there, so 200 retailer companies, 90 of them were food and beverage. So 90 out of the 200. And a further breakdown, and these are, again, just companies level, not people. Out of the 90 food and beverage, 30 were QSRs, quick service restaurants. 20 were full service restaurants. 20 were coffee concepts, and 20 were fast casual restaurants. So that was pretty interesting. There were 5 grocers there present: Publix, Aldi, Fresh Market, Sprouts, and Sedano's. And out of the 200 retailers, 51 were service categories. So that'd be health, wellness, fitness concepts. There's 14 health and wellness and fitness concepts. So that'd be a little bit medical, a little bit gyms. There's 7 convenience store, gas station concepts, 7 daycares, 7 entertainment, and 16 other service categories such as beauty and hair and things like that. There were 28 specialty retailers such as Home Goods, Home Depot, Barnes & Noble, etc. And then there's 13 general merchandise, so think like Walmart, Ross Dress for Less. And then there are 13 automotive concepts, so think like AutoZone, stuff like that. So I thought that was pretty interesting, the distribution of the types of retailers. So out of 200 of them, really, if you were to look at just service and food and beverage, that's already 140 out of the 200. So that kind of just shows you. And then if you threw in automotive too, because and I mean, so that just shows you that the tenant mix of the shopping centers changed dramatically. The food and beverage spaces been astonishing. And when you look at the tenant mix of the gross leasable area, usually the tenant mix is less than half is food and beverage when you're not counting grocery stores. Another interesting statistic is that there were 48 states that were represented at the conference. 48, like all 50 states minus 2, right? So 60%, actually 60% of the attendees, so now we're back at the attendee level, 60% of the attendees were from the state of Florida, the home state. So 40% were not from the state of Florida, which is pretty astonishing. And I didn't realize that. I always assumed that it was 80 to 90% of the people there were Florida people, but that is absolutely not the case. It's only 60%. And the top 10 states that were represented that outside of Florida were Georgia, New York, Texas, North Carolina, California, actually, Ohio, Tennessee, Pennsylvania, Illinois, and New Jersey. So people are coming from large distances, and Florida is a very important state when it comes to the retail asset class. So that kind of makes sense. I did a little bit of a comparison of the of 2018 with okay, before I get to that, actually let me keep going with 2025. So there were actually 150 students that attended the conference, 150. And what was interesting was 57 of those 150 students were from the University of Florida, and that was the top representative. The second most number of students from a university was actually UCF, which is University of Central Florida. That's actually based in Orlando. So the event was in Orlando. And that had 18. So number 1 was 57. Number 2 was 18. I think Florida State had 14. And so a lot of other a lot of other schools had a dozen or less represented. But kudos for University of Florida for understanding how important this event is and to exposing their students to the retail asset class. So I'm very glad to see that, especially since I went to the University of Florida, back in the 90s. So I'm a little bit older, but I went there and I graduated with a degree in finance. While still on the 2025 attendee list, what was also interesting was there was at least a couple dozen cities that were there, their economic development people trying to get more retailers and more developers' attention to their locations, their geography. So I thought that was great, and it also opens up the aperture for some of these students that hey, you could work for a developer, you could work for a brokerage, but you could also get your start at the city level. So that's kind of interesting to maybe work on from the municipality level, um, because the technology side of it had so much attention. I do want to name drop some of the technology companies that were there, and that so it gives you a little bit of idea. So from a data and analytics side, you had CoStar Group, which is the biggest company out there, but you also had Placer AI, which we use. Placer AI is awesome, and other companies I don't know, but companies like Locate AI and Size Up and things like that. Then there are also other market platforms such as Crexy and other data analytics companies like DealSum, which does lease abstracts, ID plans, which really inventories your property's asset information into a very easy to use platform. MRI, which is operations and accounting. There is Resquared, which is more of a prospecting tool, like a marketing tool. And then there was other companies like Vendita AI, which I haven't heard of it, but it's an AI automation company. There's CRE Grow, which he does websites and helps with marketing. Robotic imaging, which I'm not too sure about what that is, but it could be something to do with plans. IQ monitoring, which is security cameras, but not like the old-fashioned security cameras. These have a lot of AI behind it, and it's very interesting. Then there is fintech like Lev Capital. Lev Capital is almost like the lending tree for commercial properties, where you plug in what you need and it gets sent out to thousands of different lenders, and they get back to them. So I thought that just like a rundown of name dropping there. So some of the other things I want to talk about are the maybe the banks, because it's interesting because banks are kind of what kind of keeps our industry going, and I'll just name off some of the banks that were there that I saw that we met with. Bank United was there. That's one of our banks. International Finance Bank, Locality Bank, Key Bank, who I met with, Metropolitan Commercial Bank, you had South State Bank, Seacoast Bank, Suncoast Credit Union. You had Synovus and TD Bank, United Community Bank, Valley National Bank, Bank of America, Fifth Third Bank, Fairwinds Credit Union. I think Bank of Tampa was probably there. So I didn't see them, but there was a number of banks there networking and just making sure that they're staying in front of their retail operators to be able to put out the loans. And one of the other things that I did was I found a attendee list for ICSC Orlando from 2018, so 7 years ago. And I asked I use Gemini. I use Google's Gemini platform. I found that to be a little bit better. So I asked Gemini to do a pretty deep analysis to compare 2018 to 2025. So 7 years. Like, what's the difference if you went there 2018 to now, and you were in a time machine? How is that different? And so what's super interesting is that in 2018 there were 4,950 attendees, and this year was 4,139 attendees. So certainly there is a decrease of almost 15 to 20% in total attendees. That being said, the percentage of the attendees that were there that are vice president title or higher, there was 45% of the attendees this year was vice president title or higher, and it was 37% in 2018, meaning that you had a much higher chance of talking to a more senior level person here, even though there's less people here, so a little bit more concentrated on the top end. Back in 2018, there was only about less than 100 students that attended, and this year, as I stated, there's over 150 students. That was an increase of 70% when they did the math. I think there was like maybe 80 or 90 students that attended versus today, and that's huge. And if you think about it, there were a lot of, you think 150 is a lot. I didn't realize there was 80 or 90 in 2018. You can certainly notice it today, and I think they come much more prepared today, the students that is, and I think that that's great that there's a increase in number of attendees from that student population. Also, what's kind of interesting is that you've seen a lot of names, just that if you walk down memory row or you walk down memory lane, there was companies that were there in 2018 that are no longer here because they were bought or merged with a different company. Like you had DDR, GGP, Washington Prime. So those have all evolved into other companies. So that's really interesting. And for people that are in the industry, it's just make sure that it's a moving thing. It's always evolving. Another big difference was just the types of technology that were represented at the event. In 2018, you didn't have really Placer AI, or at least the way that it is today, and you didn't have a lot of other AI companies, or I don't know if even Crexy had a big presence back then. And today you have a lot more AI. And contrary to popular belief, or at least the mainstream media, would be that in 2018 there were 175 different retailers that were represented, and this year, as I stated, there's over 200. So there's actually more retail concepts today than there were in 2018 by a pretty large factor. Because if you think, the total attendees went down by 800, yet there is 25 more retailer companies that were present. So that was pretty interesting. Now, this would only be able to be done with AI unless you want to spend all weekend on it. Is that if I compared the 4,100 and change attendees from this year to all the attendees from 2018, there were about 1,147 attendees that were on both lists. So call it, if you want to round it up to 1,200. And that, so basically 27, almost 28% of the attendees that were in 2018 are also in 2025. And when I say 28, I mean, I feel like that's only 28%. I feel like when I go, I'm always seeing a lot of the same faces, but in fact, you have 72% of the attendees weren't there in 2018. So the vast majority weren't there. So that's something that is completely shocking as a statistic, and you would have never have thought about that. So another interesting fact is that of those 28% that were there in 2018, about call it just under 1,200 people that were also in 2025, 40% of them, 40% of them were promoted. So if you stuck around the industry and you were there from 2018 till now, 40% of those people got promoted. So I'll do a little name dropping because ChatGPT, or sorry, Google Gemini has it for me. But for example, you have Zach Winkler that had advanced from senior vice president to executive managing director. You have Brandon Delanois that went from vice president to managing director. You have Heather Coons that went from director of leasing to managing partner. And you have Matthew Bueller at Kitson that went from Vice President of Retail Operations to Senior Vice President of Retail Commercial. So pretty interesting. And Casey Siggins from Franklin Street that moved from Director to Managing Director. So I think that that was pretty cool. And that's all within the same company. But actually there was also promotions because they moved as well. So if you took that 40%, what did I say, 1,200 attendees, 40% of those that attended in 2018 and 2025, 40% of those were promoted. Out of the 40%, 30 percentage points of the 40 were actually within the same company. So like they state, from JLL to JLL, Kitson to Kitson, etc. 10% of that 40, so 30 plus 10 equals 40, right? That's the whole 40. 10% of those were, they moved companies to get promoted. So interesting note, you should stay with the same company to try to get promoted because the vast majority of people that got promoted within the same company. 10% did move and got promoted that way. So I thought that was pretty interesting. And some of them weren't even like a move. It was, for example, Daniel Gardner is an example because he was at Weingarten as a leasing associate, and now is at JLL with the title of Vice President of Retail Advisory. So that would be a good one. But again, that's Weingarten got acquired by Kimco. And then you have, for another instance, is JJ Bujalski, who was at RPT Realty, and now he's a founding partner of Lease. So that's another great example. Another interesting thing is that 41 of the attendees from 2018 and 2025, that they were there both, 41 of them actually started their own companies. For example, you have Nikki Perez that was a founder of Authentic CRE Solutions. You have Bobby Palta, who is a principal at Pizza At, and JJ Bujalski, who I mentioned before. So that was pretty interesting. One of the statistics that also stood out is that the percentage of attendees for both years, 2018 and 2025, of people in operation, so that would be title of property manager, asset manager, CFO, COO, anything that's not transactional, that's more operations, that made up a solid 12 to 13% of the total attendees in both years. That was pretty consistent. And I feel that a big miss right now with ICSC is that you just don't have enough programming for operations people. I think that, and I think, just being more on the transaction side myself historically, but now in everything, including operations, you have a lot of operations people like GCs and architects and things like that come to the booth and want to talk to someone about architecture services, but if all that's there are transaction people, I mean, there's just not a lot of crossover there, and it's always like, oh, here's the card for my vice president of property management, or here's the card for my project manager. I really think that there needs to be a parallel conference, even like a smaller conference, but parallel, that have all the operations people. You're talking about asset managers, construction project managers, maybe even property accountants, and so forth, attend with all of the service providers, the GCs, the architects, the landscapers, the cleaning companies, everybody. I think that if you had that environment where it's just very effective and there's no guessing and everyone you talk to is in operations, I think there'd be a lot of value there, actually. So I would highly recommend ICSC in considering that. If you want to talk more about, if ICSC is watching this and you want to talk more about that, I'm happy to speak with you, so reach out.
All right, I'm here with Shannon at Miller Construction. I just met her. She's doing business development for Miller Construction.
Hi there, I'm Shannon Herring. I'm the business development director for Miller Construction Company. And we are here in Orlando, and we are making deals happen, and we're making lots of connections. Orlando is the place to be, and it is a great conference. Looking forward to seeing everyone tomorrow. And there's so much energy happening in this conference center.
I think that'd be great. Actually, so Saglo on Sunday, we put together a property manager's dinner. So I think we had like 40 people this year, and we had six different companies sponsor it. So we had GC company, a property with IQ company, IQ security cameras, and we had a lighting company, and a number of companies sponsor it. And then we invite property management professionals, senior level to mid level, also attend, and we just have a great time, do some networking and exchange notes, and it was really well received. So we do that on Sundays, and I think that maybe that can be that spirit of it can be expanded to the whole conference. Now I'm going to get into kind of the day-by-day playbook of Sunday, Monday, and Tuesday at the conference, and give you some. Now I'm going to get into kind of analysis from what I saw, and just the logistics of the event itself. So Sunday, I always started off at Bubbaloo's Bodacious Barbecue, which is a great barbecue spot in Orlando. They have great they have smoked meats, they have pulled pork, they have all sorts of good stuff there. And I read the book, I think it's called Never Eat Alone, but I try not to eat alone. So I said, hey, if I'm going to go here anyways, let me invite some people. And I had a great group of people come join me and start off the networking with that. So I highly recommend, if you're gonna get there early anyways, go grab lunch, but also grab some people so that you don't miss that opportunity to since everyone's in Orlando anyways around that same time. At the convention hall itself, I found that getting there 30 minutes early, there was already a lot of people at the convention hall because they're setting up, they're whatever, there's round tables and things like that. And then the networking event itself, not the networking event, sorry, the opening cocktail reception is really well attended, like crazy well attended. You're going to see so many people there that I actually posted about it on LinkedIn, and a number of people, like beforehand, a number of people came up to me at the event and said, "Oh wow, I took your advice, I came here, and I'm just blown away at how crazy well attended." You're going to see so many people there, that how high level of the people that are attending and how much like effective networking can get done at that event. You're just bumping into people that you can totally do business with, or you should totally meet. And then I always say there's like two golden hours. There's how 30 minutes before an event starts, and then the last 2 hours of the event. And I think that some of the best conversations are in those times, because in the middle of the event, it's just super busy. It's just hard to really to hold attention and to talk. But at the very beginning, before it starts, you can have some great conversations, meaningful ones, and there's some of the the best, real deal makers, the people that are really executing, are getting there early and staying late, and then all the way at the end, same idea. Like, you don't leave early, just stay all the way towards the end. 30 minutes before an event, I'll give you a couple examples. Like, for example, Brian Hector at Kite Realty, he is just really hard to get a hold of. And last year we shut it down. Event ends at Tuesday at 2 p.m. I was at his booth, last year at 2 p.m. Because he was finally freed up and talking. This year, I got there 30 minutes before it started, and there he was. He was already there 30 minutes before it opened up, and we got to be able to speak a little bit before it opened. So that's one great example. Another example is that the last 10 minutes on Monday, we were at our booth. I mean, it was 4:50 p.m. and I had someone that owned shopping centers, like a local guy, not a guy that you would like. Very few people probably know this person. Like a local guy that just is a owner of a shopping center, said, "Hey, I'm looking to sell my shopping center. Can I talk to you about it?" So that was 4:50 p.m. on Monday, and it just goes to show. And so I need to follow up with him and see if something can get done there. Another great example of the magic hour, or sorry, golden hour, is that so Tuesday this year, the last 30 minutes of the show, and I mean, if there's 4,100 and change people that were in total attendance, the last 30 minutes there might have been, I don't know, 200 people there, maybe 100. But I bumped into, I think it was, if I had to count, four principals and some very high level deal makers those last 30 to 60 minutes of the show. And my very last discussion, I was actually over at John Gersberg's booth over at Marcus Millchap, and got to meet a new principal who I had not known before, based out of South Florida, that owns and operates retail. And I learned a lot more about the technology side of things that John has seen and is exposed to, and has friends and connections doing that were really interesting. So I have to do some more follow up there. And that's the key. You need to follow up. Make sure you enter all those cards into your CRM. Make sure you're following up. Whatever you said you're going to send or whatever, go ahead and send it. Sooner the better. I will talk a little bit about my workflow that I felt was pretty good. Is that I was using Evernote to take pictures of people's badges in order to follow up with them, even people I already know. So I don't need their business card because I already have their contact info, but I do want to remember to follow up with them. So I take their picture of their badge within the Evernote app, so it gets embedded into a note. And then I would just type in the space right above it, like, what do I need to follow up with them? It could be, hey, send them a package on this shopping center, or hey, they wanted to get referred a lender, so send them a lender, or something like that. And so I thought that was pretty effective. The first time I did it that way, but I thought that was pretty good. And on Sunday night, I got invited to the Cushman and Wakefield dinner. So really, appreciative of Mark Gilbert and Adam Feinstein of Cushman and Wakefield's Miami office. They are heavy hitters, and we have a great relationship with them. They put together a great dinner over at the Del Frisco's restaurant right on I-Drive, private room. I think they probably had like 60 people attending. And those dinners, Frisco's, are not to be missed, and certainly everyone in there was someone that, hey, we could probably do business with at some point in the next 5 to 10 years, if not sooner. I mean, hopefully sooner, but meaning that it's, real estate's a long game. So you build those relationships, and you never know. Like I met Jack Glotman, whose father started Saglo, I think like 10 years before I actually came to go, work at Saglo, and today I'm president of Saglo. On Monday morning, we had Higher Call, which is a Christians and commercial real estate breakfast that is held with a prayer. It's a prayer breakfast and good networking as well, but it starts really early. So Monday at 6:30 in the morning, it starts at the same convention center, but they just have their own room. Morning, we had Higher Call, and we had an amazing speaker, John Crossman with Crossmark Companies, tell us some personal stories about himself, and it was very inspirational. So I think that next year, if you are attending, I recommend it. I thought that had great takeaways from there. In the morning, and we had an amazing speaker, John Crossman with Crossmark Companies, tell us some personal stories about himself, and it was very inspirational. So I think that next year, if you are attending, I recommend it. I thought that had great takeaways. Actually, one of the things that I was a part of was an ICSC panel called DMs to Deals, and I was on the panel with John Crossman of Crossmark, but also Alexi Fonseca of Colliers, and also Paul Rutledge of LQ Commercial. And we all have different views and different strategies as far as social media, and we were speaking with the audience on what are some of the best practices that we've seen actually result in measurable success and kind of how do you define success? And it's not just a number of followers. You can be successful even if you have 500 followers. You don't have to have 100,000 followers. And how can you get there? And at the bottom line is that you have to really identify your core audience. You can't be all things to all people, and figure out who is it that you're trying to work with. And then don't let perfection hold you back, because you don't have to have the perfect image or the perfect selfie or the perfect text. Just post things that are meaningful, that could be engaging, and that provides value. I think that's the best advice.
Since you're very involved.
Yeah, I think what's important for all of you guys when you're thinking about this is like, it's not about becoming one of us. It's about developing your own brand that works for you, right? And so in my world, like obviously I have a commercial real estate company and I'm promoting that. I also do a lot of work with students, and then I also really like to promote topics. I'm very passionate about promoting mental health and different issues of diversity and things like that. So my messaging is different than Alexi's, but we could both be successful, even though it's the way we're doing that's different, right? I think it's what's important as long as staying consistent. Like with Paul, I'll do things on multiple formats, but I am thoughtful on the wording. Like if you see, I might have the same post on Facebook and Instagram and LinkedIn, but it's not the same wording, right? Because when I'm promoting, like let's just say mental health, I might do something on my personal Facebook page that I tell a little bit about myself and that. But when I do it on LinkedIn, I'm like, hey, CEOs, here's 3 thoughts you can think about how to promote mental health for your employees, right? So I think you got to understand what is your brand you're trying to promote, what's your audience, and then make sure you're detailing that message towards them.
The Saglo booth itself was in the very back row of the convention hall, and right by the networking lounge. I'll tell you, this is I think the 4th or 5th year that we had it back there, and it is an amazing location. That networking lounge has maybe about 40 or 50 tables set up, all high tops, and there's direct line sight to our booth, and it just made our booth so much easier to be seen, but also to be found. And then we can use those tables. If our tables were filled up, we can just go right there, across the aisle and use those tables. So it was both effective and good marketing. I can tell you that I know I had recommended using Otter or some of these transcription services for the meetings. I didn't end up using it as much as I thought I would, but I still recommend doing so if you have that. The at Florida State University has like a shadowing program, and they do a great job. So Yvonne Baker, who runs the program, does a great job connecting industry veterans like myself and Beth Azor and a few others with Florida State students that are attending the event, and they just shadow us for like an hour. So I had students shadowing me from both Monday and Tuesday. So I thought that was a very good initiative on their end in learning about how we do things firsthand. And on Monday I did a hybrid approach with the scheduling. So I set a total of 6 to 8 actual meetings that were 30-minute blocks, but the rest of it, because I've been going for 25 years, I know a lot of people already, and I'm very good. I'm very forward in networking. I just figured I might meet a lot more people, have a lot more conversations, shorter, like 5 to 10-minute conversations, if I just kept it flexible, and that worked out beautifully. So I am totally doing that again next year. I would say that one of the advices I had was the lunch is underwhelming, and let me tell you, this lunch this year was like it's always cold chicken with some lettuce and some rice, but this year the chicken was colder than normal. It was like really cold chicken, and then the rice was really undercooked and bland rice, and the lettuce was wilty. I mean, this lunch was just horrible. So if ICSC is reading this or watching this, you gotta step it up with the lunch, because I mean, go with a buffet. Like if the plated lunches are, if it's a cost thing or whatever, I mean, it's just not a good lunch. So I won't. That's all I will say about that. In the past, pre-pandemic, there would always be a keynote speaker. Maybe it's an economist, maybe it's an industry expert that talks about the state of retail and things like that. And largely the last few years, they've gone away from that. I suggest they bring that back. I found that part of it very valuable. I found that the programming this year was a little bit sparse. I mean, they had a few panel discussions in that what they called showcase theater or something like that, the one that I was on. But like real keynotes, they didn't have any of that. So I think that a little bit better programming could bring more value to the members coming to the event, and especially like programming revolving technology, where there's no avoiding it. I really think that ICSC needs to keep pushing AI prompting and just some of the skills, the technical skills that you need to know to use the AI and to implement it into your business. One of the real big takeaways is that there is just a lot of capital pursuing retail, value add retail. I mean, all retail is going to be value added, or all commercial real estate is going to be added to some degree. That's you're not buying it without, it's not like you're buying gold or something. So meaning that the intent for, even if you're buying Class A property, like Eden's is a great example of being able to, and Federal Realty, of executing on Class A stuff very well. You're buying something already nice, and you're buying it at a low cap rate, and you're looking at the tenant mix and saying, hey, if I just shift this tenant mix around a little bit, and that's able to generate that much more traffic, and it's able to attract that much more in disposable income, that's going to raise the tenant's sales, and that's going to allow me to charge a lot more rent. And then that's also going to lower my cap rate because, the high sales show that's durability of income. And then, those are very well-known tenants. So that's going to be something that seems to be less risky. And so that leasing side of it, I feel that needs to be kind of expressed more to the students. There's 150 students. A lot of them want to be developers. A lot of them want to be developers or analysts. And I think that on the leasing side, you're working with that income side of the equation, right? Because you got to determine the value of the shopping center. The value of the shopping center is the NOI, net operating income, divided by the cap rate. But the NOI, how you get that, is your gross revenue minus expenses, and or your base rent, your reimbursement expense your expense reimbursements minus general vacancy, and minus expenses, gets to your NOI. So the leasing side of it has a direct effect on both your base rent income and your expense reimbursement income, and you want to keep your general vacancy low, and you do that by showing track record at the property that can stay occupied and things like that. And so I think that there's not enough focus on that. And on the cap rate side of it, it's not like, hey, let's just use a market cap here. Your cap rate can be below the market cap if your property is deemed to be a less risky investment. Your income stream is more durable. Your growth rate of the rents are better. You have stronger CAGR, moving forward, meaning you have the ability to grow rents projected into the future. So I think that kind of art form is hard to really teach through a textbook. You kind of have to do it. And so I don't know if there's like retail leasing courses or seminars that the schools can adopt, but and maybe it's ICSC that can kind of help push it. But I highly recommend really understanding the leasing side of it, because that is the value. That's the value add side of it. Your cap rate and your gross revenue part of it. So just think of it that way. My very first ICSC conference, my very first ICSC Florida conference was August of 2001, and I only missed one ever since then. So I've gone to many of them, and the one that I missed was because I was on a sabbatical in 2010, which that's a story for another day. And so I've gone many times. I'm speaking from experience, from the first person perspective. I'm speaking as an owner operator. I'm speaking, I did retail leasing the first 12 years. I did acquisitions, and I still do acquisitions, and I'm still involved in leasing, but I'm also involved in operations, which includes property management. It includes accounting, capital markets. So I see all of it, and I'm telling it to you from a 360-degree perspective. And so I recommend going next year if you weren't able to go this year, and I hope you enjoyed my recap. I do want to talk to you a little bit about Saglo companies. So we own and operate 2.5 million square feet of shopping centers, mostly in Florida, but we're also in Atlanta, and we're in Maryland, and we're looking to grow. So we would like to buy additional properties east of the Mississippi River in the United States, and we're looking for shopping centers where we can get good yield, but it's also a good community. It doesn't have to be a sexy center. It doesn't have to be a sexy community, but if it's a safe community, there's reasons for people to move there, and the cap rate's a little bit higher, maybe because there's rollover risk, or maybe it's because the tenant mix is not standard, meaning that maybe there's a thrift shop, or there's something there that's not standard. That's kind of what we like to buy. And so we are looking to buy. We also, as I stated, we have 24 shopping centers in Jacksonville and Tampa and Orlando, Miami, and we're in Melbourne, we're in Atlanta, and we're right outside of Baltimore, DC. So we have space available for lease. So if you're a retailer, please take a look at our portfolio on our website at saglo.com. And some of our highest priority spaces would be that I do have a Big Lots space that came back to us in the Jacksonville market, but it's a great market. It's in the Mandarin submarket of Jacksonville, off of San Jose Boulevard and Old St. Augustine Road. And I think that would be, and it used to be 3 spaces, so it's not very deep. And to split the spaces is extremely fast, because they only combine the spaces by opening up these 20-foot openings. And so I can deliver 16,000 square feet or 7,000 square feet fairly easily. So check that out, and subscribe, comment below, share this with anybody that you can. This is a new YouTube channel, and if you don't remember anything else about Saglo, just remember that we like to buy, lease, repeat. So we buy, we lease it, we repeat. Buy, lease, repeat. All right, thank you.
Land of lights. Here we go. The heartbeat of the street. Let them know. Bright light pulls in, a new year begins. Forget the emails, let the real work commence. 4,000 pros walking through the door. You know the mission. You know what you're here for. From the sun to the I drive night, gotta find your focus, gotta shine your light.
aren't just handshakes. It's the seeds of the future, planted in the noise. Now you just have to let them grow.